Hello everyone, and welcome to Next Board. Today, we're spotlighting an essential skill for anyone interested in investing or financial management: how to read financial reports like a pro. Whether you're a beginner or experienced investor, knowing how to analyze a financial report is key to making informed decisions. In this video, we'll guide you through the key elements of financial reports and how to interpret them effectively. 1. What is a financial report? A financial report is a document detailing a company's financial performance. It typically includes key financial statements such as the balance sheet, income statement, and cash flow statement. These reports help investors, analysts, and managers assess a company's financial health. Why is this important? Understanding financial reports enables you to make informed decisions about your investments. It allows you to evaluate a company's profitability, liquidity, and financial stability before deciding to buy, sell, or invest further. How to access them? Financial reports are usually available on company websites in the Investor Relations section or through specialized platforms like Yahoo Finance or Morningstar. 2. The balance sheet. Understanding financial structure. The balance sheet is one of the most important documents in a financial report. It provides a snapshot of a company's financial position at a specific point in time, detailing what it owns, assets, what it owes, liabilities, and its net worth, equity. Why is this important? The balance sheet helps you understand a company's financial equilibrium. If liabilities exceed assets, it signals high risk. Conversely, a surplus of liquid assets indicates the company is well positioned to seize new opportunities. How to analyze the balance sheet? Assets. Examine the composition of assets, current versus non-current. Current assets include cash and receivables, while non-current assets are long-term items like property and equipment. Liabilities. Review liabilities, current versus non-current. Current liabilities cover short-term debts, while non-current liabilities include long-term obligations like loans. Equity represents shareholder investments plus retained earnings, essentially the company's net worth. 3. The income statement. Evaluating profitability. The income statement summarizes a company's performance over a given period, typically quarterly or annually. It outlines revenues, expenses, and net income, profit or loss. Why is this important? The income statement reveals whether a company is generating profits and how it achieves them. Analyzing revenue and cost dynamics allows you to assess profitability and profit margins. How to analyze the income statement? Revenues. Track revenue growth compared to previous years. Consistent growth indicates good business health. Costs. Review costs tied to producing goods and services, e.g., production, marketing. Excessive cost increases can impact profitability. Net income. This figure reflects overall profitability after expenses and taxes. Compare it to previous periods to identify trends. 4. The cash flow statement. Understanding liquidity. The cash flow statement outlines how a company generates and uses cash over a period. It is divided into 3 sections: operating activities, investing activities, and financing activities. Why is this important? Cash flow shows whether a company has enough liquidity to fund operations, make investments, and pay debts. Even profitable companies can face challenges if they lack cash flow. How to analyze the cash flow statement? Operating activities indicates cash generated from core business operations. Investing activities reflect spending on new assets or proceeds from selling existing ones. Financing activities covers cash flow from issuing or repaying debt and equity. Excessive share issuance may dilute existing shareholders' value. 5. Key financial ratios to watch when reading a financial report. Certain financial ratios help you understand a company's strengths and weaknesses. Here are a few critical ones. Liquidity ratio, current ratio, measures a company's ability to pay short-term debts with current assets. Formula, current assets, current liabilities. Profitability ratio, net profit margin, evaluates how profitable the company is. Formula, net income, revenue. Debt to equity ratio, highlights the proportion of debt versus equity. Formula, total debt, equity. Why is this important? These ratios quickly gauge a company's financial health. For example, a high liquidity ratio indicates the ability to cover short-term obligations, while a high debt-to-equity ratio signals increased risk. 6. Interpret analyst notes and future outlook. Financial reports often include analyst commentary and forecasts that provide insights into the company's future prospects. Take time to review these sections for expert opinions and strategic direction. Why is this important? Analysts consider factors such as market trends, economic conditions, and competition, offering a better understanding of the company's future potential. How to find these insights? Look for sections titled Financial Forecasts, Growth Prospects, or Risk Analysis in financial reports. Conclusion: reading a financial report like a pro takes practice, but understanding key elements like the balance sheet, income statement, and cash flow statement will enable you to evaluate a company's financial health effectively. These skills are essential for making informed investment decisions and assessing growth potential or risks. Thank you for watching this video. If you'd like to deepen your financial analysis skills or discover tools to optimize your investments, don't forget to subscribe to Next Vault for more tips and resources. See you soon on Next Vault.